Real estate investment trusts, commonly known as REITs, are a compelling investment option for those seeking exposure to the real estate market without the hassle of direct property ownership. REITs are publicly traded companies that own, operate, or finance income-producing real estate. In this comprehensive guide, we will delve into the world of REITs, understanding how they work, the various types available, their advantages, potential risks, and essential considerations for potential investors. A real estate investment trust, REIT, is a corporate entity that specializes in owning, managing, and financing income-generating real estate properties. Unlike traditional stocks or bonds, REITs offer unique characteristics, making them an attractive choice for investors. These characteristics include dividend income. REITs are mandated by law to distribute at least 90% of their taxable income to shareholders in the form of dividends. This consistent income stream makes them an appealing option for income-oriented investors. Portfolio diversification. REITs provide investors with an opportunity to diversify their portfolios across various real estate sectors, such as office buildings, apartments, hotels, retail stores, healthcare facilities, and more. This diversification can help reduce investment risk. Liquidity. REITs are listed and traded on major stock exchanges, offering investors the flexibility to buy and sell shares readily, providing a level of liquidity that is often lacking in direct real estate investments. Tax benefits. REITs come with some tax advantages for investors, including the ability to deduct losses from their taxable income. How do REITs work? REITs operate as corporations but enjoy unique tax benefits. To qualify as a REIT, a company must meet certain criteria. At least 75% of its income must come from real estate activities. It must distribute at least 90% of its taxable income to shareholders. It must have at least 100 shareholders. By adhering to these guidelines, REITs are exempt from paying corporate income taxes, making them a tax-efficient investment structure. Instead, shareholders are responsible for paying taxes on the income they receive from the REIT. Types of REITs. REITs come in various types, each focusing on specific real estate sectors. Equity REITs. These REITs primarily own and manage income-producing properties. They generate rental income and capital gains by leasing and selling properties. Common subtypes include office REITs, residential REITs, and retail REITs. Mortgage REITs, MREITs. These REITs invest in mortgages and mortgage-backed securities. Their income is derived from the interest earned on loans provided to property owners or by purchasing mortgage-backed securities. Hybrid REITs. These REITs combine elements of equity and mortgage REITs. They may own properties while also providing financing through mortgages or other real estate-related loans. How to invest in REITs. Investing in REITs can be done through various avenues. Individual REIT shares. Investors can purchase individual REIT shares directly on the stock market, allowing them to choose specific REITs based on their preferences. REIT mutual funds. REIT mutual funds pool investors' capital to invest in a diversified portfolio of REITs. These funds offer diversification and professional management. REIT exchange-traded funds, ETFs. REIT ETFs provide a way to invest in a collection of REITs, similar to mutual funds. They are traded on stock exchanges and offer liquidity and diversification. When considering an investment in REITs, it's important to evaluate several factors. The type of real estate the REIT specializes in. The geographic location of the REIT's properties. The quality and experience of the REIT's management team. The financial performance and stability of the REIT. The REIT's dividend yield and distribution history. Real estate investment trusts, REITs, present a compelling opportunity for investors seeking passive income, portfolio diversification, and liquidity in their investment strategy. However, potential investors should be aware of the risks and nuances associated with REITs, such as interest rate sensitivity, volatility, and the fact that REITs are not a substitute for direct real estate investment. Before investing in REITs, it is crucial to conduct thorough research, consider personal financial goals, and consult with financial advisors to ensure that this investment aligns with your overall portfolio strategy. When used wisely, REITs can be a valuable component of a well-balanced investment portfolio, offering both income and growth potential in the dynamic world of real estate. Thanks for watching. Please subscribe to Good to Know.